perspective, we have seen that today the Nifty has ended in a positive territory, but it's the first weekly loss in the past 4 weeks that the benchmark indices have clocked. But yes, barring the benchmark indices, it's the mid-cap and small-cap indices which have done fairly well today. And for this week itself, they've outperformed the benchmark indices with about 1% gains. But yes, a couple of events that have shaped the markets this week right on your screen. We've seen that there was fresh tensions which emerged in the Middle East, which is why Donald Trump also said that the MOU with Iran is over, and that led to a surge in the Brent crude prices by about 7 to 8% before settling at about $75 per barrel. But yes, apart from that, we did see FOMC minutes also that had come in, showcasing a division over the rate cuts until the inflation path was clear. And currently, the shipping in the Strait of Hormuz is something that we'll be watching out for because of the fresh escalation that has taken place. But yes, apart from that, those were some of the key events that have shaped the markets this week. But yes, on that note, let's quickly shift the conversation and talk more about markets from a long-term perspective. We have with us Seshadri Sen, who is the Head of Research and Strategist, Institutional Equities of Emkay Global, joining us. Seshadri, good afternoon. So good to have you back. You know, we have seen fresh tensions this week, and with Trump saying that the MOU with Iran is over. So how far do you think such kind of escalation can impact markets from a short-term basis?
Sorry about that. Difficult to predict, but clearly the oil prices are telling you something, that they don't think that this is a longer term worry. This is probably a part of the negotiations and the negotiating tactics between the US and Iran. And both sides will come back to the table at one stage. For sure, Brent crude at $78 and the Nifty where it is certainly not discounting a full opening, recommencement of hostilities in the Middle East and the Strait of Hormuz shutting again. We also have to remember that oil prices, there are other factors. Suddenly demand has dropped off. So, there is another reason for crude not to spike. So at this point in time, I think it's contained. The markets wobbled for a day and ultimately India's internal fundamentals took over. And I would not worry too much about this unless this escalates, and keep a close eye out on Brent prices. Of course, if this is another extended conflict, then we have upside to oil and downside to the Indian markets. But that's not my base case scenario. I don't think that will happen.
Okay, got it. Seshadri, then, do you think the markets will now focus more on earnings instead of such geopolitical events?
Absolutely, I think the focus will shift to earnings. In the Indian context, we earnings have been in the fourth quarter resilient. Our forecasts show that maybe the fourth quarter will also be reasonably resilient. The first quarter will also be reasonably resilient, except for one-off losses in oil marketing companies and some margin pressures where there were supply chain or price challenges to manufacturers. But by and large, we think that earnings will remain fairly solid. We are in for the broader Indian market. We are in for one of the best years of earnings in the last three. After a sluggish 25 and 26, we think FY27 will be see a sharp bounce back, not only in the headline Nifty earnings, but in the broader perspective. This earnings season should largely reinforce that. If there are one-off hits to particular companies because of the conflict, I think the market will look through that.
Got it. Seshadri, I was going through your note, and it was mentioned that you're pricing in for a 15% EPS growth for FY27. You know, if you look at last 2 years, we started off with similar kind of growth projection, but ended up with 4 to 5%. So currently, what is keeping you this optimistic?
Well, the underlying economy has been, ever since the stimuluses that came through in calendar 25, we started off the year with tax interest rate cuts, and then through the year that came in, then there was a tax cut, and then GST. All that is coming through. If you look at the latest consumption numbers, all across the board, they're coming through fairly strongly. Capex is also holding up reasonably well. So there is much stronger underlying strength. Remember, 25 and 26 was affected by the twin tightening that India did around calendar 24, when both fiscal and monetary policy went into tightening mode for fear of inflation and NPLs. So at this point in time, I think the economy has tailwinds on its back, and despite the external shock that came from the Middle East conflict, consumption has held up through these 2 quarters. Banking, which was one of the sources of the disappointment, is coming out of both a margin and an NPL cycle. So I think 27 earnings, 15% growth looks highly achievable. We are not worried that the last 2 years saw downgrades because the macro environment was very different in those 2 years.
Okay, got it. Seshadri, your expectations from at least the June quarter in terms of how large, mid, and small caps are expected to fare in terms of their growth?
Mid caps will continue to be the best. Small caps will be better, and large caps will be sluggish. Large caps, of course, the OMC losses will distort the headline, but even if you strip that out, I think large cap earnings will remain in the high our weighted average Nifty forecast for the fourth quarter for the first quarter is 10% versus 15% for the full year. So this will be a slow start to the year for large caps. Mid caps and small caps will outperform. But that's fine. We have plenty of time to catch up. Subsequent quarters will not have to deal with elevated crude prices.
Okay, got it, got it. Seshadri, let's shift the conversation to the top talking point today. That's your TCS. Reported numbers mostly in line with what the street was anticipating. And now the company is seeing some sequential growth in their AI revenue. Do you think this is finally the first sign of AI monetization? And does this revenue growth change your overall stance on overall Indian IT?
We've not been as negative as some of the street has been on IT, when especially after the collapse. We think that at a price, at a valuation, when implied growth falls to say 0 to 2% in dollar terms, the IT sector does offer value. The AI story will, in the short term, obviously AI will, I think, represent more pain than opportunities. But over the medium term, we think that the overall spending pie of clients will go up. Indian IT companies may get a smaller share of that pie, but it will still grow. And when you're priced for very low growth, then that comes into play as well. We do think that there are no major triggers for the IT sector in the next 3 to 4 quarters. But from a longer term perspective, valuation does provide comfort. So for patient investors, this is an opportunity to get in and wait. But in the immediate term, the AI deals are too small to really move the needle.
Okay, got it. But from a 4 to 5 years time horizon, if an investor is looking at the current levels, do you think they offer an opportunity for an accumulation?
4 to 5 years is tough to predict for technology companies. You don't know, so many things may change. But from a 2 to 3 year perspective or a 2 year old perspective, I think this is a good time to look at it. But with the warning that, one, in the short term there could be further falls. Another release by Anthropic, and you could see the Indian IT companies take a beating. That's one risk. And even if that doesn't happen, the recovery will, market will want to see the trend is so much against the IT companies that they will want to see visible signs of a recovery before big time buying comes in and the stocks start to move.
Okay, got it, got it. We just have first numbers by the Nifty companies. Let's talk some of your preferred bets and any themes that you're liking ahead of the earnings season.
We are overwhelmingly constructive on consumption and consumer discretionary. Autos, of course, forms a large part of that thesis, because if you want to put, large caps are in the discretionary space are largely autos. So autos is one theme. Internet is another theme that we continue to like. We think these companies are genuinely disruptive, creating long-term value, and have a clear path to profitability. One final thesis. There's some new sectors which are also emerging. We added a textiles company to the portfolio recently because I think there a lot of things are coming together to be very positive for that. So there are a few of these smaller sectors which are emerging, as very strong themes. Tires is emerging as a theme. Diagnostics is seeing a lot of tailwinds. We've had diagnostic stocks in the portfolio for a while. So some of those smaller themes are get looking quite interesting.
Okay, got it, got it. Seshadri, what about the autos? Of course, we are seeing double-digit growth when it comes to sales for all of these PVs and EVs also for that matter. But how do you see the second half to pan out when they will be dealing with a higher base of last year when the GST cuts were announced?
I remain, I think the GST cut was a structural demand shift. It's not going to die out in a year. So yes, coming to the second half, they will deal with a higher base, but you will still see growth, which will surprise on the upside. We are constructive on CVs. We have been for a while. Monsoons may be a short-term risk, but if that creates a correction, then buy into that. And and PVs and two-wheelers we continue to like, almost equally. So we remain very constructive on the auto space, as we are overweight on it. And I think I don't worry about the base effect. Growth will come through. The underlying demand is very strong. The GST cut opened up the TAM for some of these products significantly, and that doesn't translate into a one-time pop in demand. It creates a long-term, 3-4 year momentum in demand.
Okay, got it, got it. That's your auto space. But Shadri, we have seen that a lot of realty stocks have been shining through this month, and analysts, whoever I spoke to, they're saying that these gains are coming after a large underperformance. We think, but how are you placed on the realty pack? Because so far we have seen that the premium sales have picked up, but affordable still remains sluggish.
Largely what you just said, valuations are too attractive to ignore. Yes, realty is coming off a very strong growth period, and across the companies, we're seeing that growth in top line is starting to slow vis-a-vis where it was, but it's not crashing. This is not a bear market in real estate. There's growth still to come. Nature of the growth is changing. For example, in Mumbai, you're seeing a lot of redevelopment growth coming through. But the growth overall in across most of the major cities remains reasonably okay, albeit not as high as the previous 3-4 years. However, as you just alluded, valuations have come down. A lot of them are quoting at discounts to NAV or at NAV, which ignores future growth. So we would, we're not, we would be selective. But we do have some exposure to real estate. We think one thing that has been ignored is that interest rates have fallen by 125 basis points. Mortgages sees the smoothest transition or the smoothest transmission of interest rates to the borrower. That will be a positive for demand over the longer term.
Okay, got it. Seshadri, you mentioned that you're bullish on the consumption theme. How far do you think the El Nino risk is going to impact any kind of sentiment?
I am not too worried. In the short term, it could create a sticker shock impact. You could see valuations, etc. First of all, most of the companies that we recommend cater mainly to the urban market. They, this drop, any potential drop in rural incomes doesn't affect their growth to that extent. Inflation would be a worry, but the government's done a pretty decent job in controlling inflation in El Nino years in the last 8 to 10 years. So we think there are enough buffers, etc., to manage any unreasonable spike in inflation due to El Nino. So yes, there may be headline damage and you may see a correction. If it does, then that's an entry opportunity. Even from a 6 to 12 month perspective, we don't think El Nino is a big worry. Though we are worried that the monsoon may be poorer, but the consequent impacts may not be as severe as used to be in the past or as a lot of people think.
Okay, got it, got it. Seshadri, what about your take on the financial sector? I mean, last quarter we have seen a bit of a tepid growth, but how do you see the next quarter to pan out? And of course, this quarter also, what are your expectations?
Yeah, we're seeing reasonably strong earnings growth. FY27 will be the best year for financials in quite some time. I think last time was 23 or 24 when they had such a strong year. However, longer term, I think financials have lost that feature where they would deliver alpha, would be the leaders in a market recovery. In a strong bullish market, we think financials are not the stocks to own. Obviously, with that kind of weightage, you can't ignore the sector you have to own. But we would be underweight and prefer consumption or even industrials over financials as alpha generators. Financials gives you a solid base to the portfolio, gives you steady compounding, the higher quality names. But being overweight is probably not a good way to try to look for alpha. So that's the broader view. Within financials, we prefer the riskier, smaller names and NBFCs because they give you that growth beta. And even though, yeah, and the possibility of potential re-rating, not just compounding stories.
Okay, got it. But Seshadri, does the slower deposit growth make you concerned about their path to profitability? And of course, where does that make you stand on their margins front going from here on?
Uh, um, Aggregate deposit growth is not a worry. I think it will pick up as M3 picks up. Maybe the money multiplier, maybe the RBI's liquidity stance, etc. The FCNR, if that finally flows through to domestic liquidity, would help. But the recent RBI FSR report had flagged that CASA ratios are falling very sharply. Our estimates show that the share of household equities in household finance has doubled in the last 10 years. And that is showing through, and that plus more awareness is impacting CASA and float deposits. So while deposits in aggregate will be available, low cost deposits will be a little harder to come by. Competition is intensifying. Fintechs have sort of equalized the service gap between the better and the weaker banks. So we don't worry about the availability of deposits. We worry about the cost of deposits on a structural basis vis-a-vis the benchmarks over the last 2 3 years, and that would, we think, have a longer term impact on margins. But in the next year or so, because the banks are running very high incremental LDRs, that that is margin accretive. So in the next year or so, it may not manifest. Plus, you got the lead lag from the rate cuts, but from FY28, we would start worrying about margins.
Okay, got it, got it. Seshadri, where do you think the market has turned to optimistic right now? And of course, where it warrants an attention? For the time being, you did mention a slew of themes that you have been quite optimistic. But where do you think the market is pricing in too much of an optimism where it's not warranted?
Tough to say. Markets coming out, 2 years is delivered nothing. So most of the froth has subsided in that space. Of course, there are 60 70 p industrial companies which I think are it's tough to make money if you enter despite the hyper growth. And some of these are one-off growth opportunities. You can't attach high multiples to that. But in every sector there may be the odd companies where the market is a little too optimistic on growth and are assigning unrealistic multiples. But by and large, 2 years ago there was much higher latency of that to now. The incidence of overvalued companies has come down significantly, so we are not too worried. Of course, you will find pockets of overvaluation, but in general, I think markets offer more opportunities than risks.
Okay, got it. Got it. Shashadri, the recent AMFI data is showcasing that the SIP inflows has hit a 3-month high for the month of June. Does this give you the confidence that the risk appetite could be back in the markets?
Yes, I think structurally and in the short term, risk appetite would be back as the market gets momentum. Some of the more fatigued investors will come back into the market, and longer term, we've said that and this is a slightly contrarian view. We think that Indian households are still underinvested because we are over, a very very small percentage of India's working population have assured pensions, so they need to build wealth. Interest rates are structurally low. Tax incidence on fixed income is quite high. So equities is one of the most preferred, will continue to be one of the most preferred asset classes for household investors, and the share of equities in households will continue to rise, and SIPs and mutual fund flows will be a large part of that.
Okay, got it, got it. All right, Seshadri, on that note, we have to let you go, but wonderful conversation as always, and thank you so much for your time.